Do you know that the lot categories introduced by retail brokers were still too big for many people? Imagine a minimum deposit of $1,000. That is still a lot of money, and yet the market needs more participants. So brokers introduced another mechanism to bring more people into CFD trading, and that is called leverage. Think of your broker like a bank that fronts you a larger amount of money to trade. For example, the broker can allow you to control $100,000 in the market while you only deposit $1,000 as a good faith amount, known as margin. This money is not taken from you. It is held to support your trade. This is how trading with leverage works. The amount of leverage you use depends on your broker and what you are comfortable with. Usually, the broker requires a minimum account size, also known as initial margin. Once you deposit your money, you can start trading, and the broker will also specify how much margin is required per position or per lot. For example, if the broker requires a 1% margin, it means for every $100,000 traded, you need to deposit $1,000. So if you have $5,000, you may be able to control up to $500,000 in the market. Some brokers describe this in terms of leverage ratios, while others use margin percentage, but the relationship is simple. Leverage equals 100 divided by margin percent, and margin percent equals 100 divided by leverage. Leverage is commonly shown as ratios like 100 to 1, 200 to 1, 500 to 1, and even up to 1,000 to 1. This means you don't need thousands of dollars to trade anymore. For example, with a leverage of 1,000 to 1, even $1 in your account can control $1,000 in the market, which is equivalent to a micro-lot position of 0.01. With a leverage of 500 to 1, you would need $2 to reach the same $1,000 exposure. But even with this, you cannot just open trades freely. You must also consider the required margin per position, broker commissions, and enough balance to protect your trade from going into a negative position. If your account balance falls below the required margin, the broker will automatically close some or all of your positions. This is called a margin call or stop out, and it protects your account from going negative, especially in fast-moving markets like gold. For example, in XAURUSD, you might need around $7 with a leverage of 1 to 1,000 to open a position, and if your loss approaches around $3, you may receive a warning before the position is closed. For Euro to US dollar, you might need about $1.50 with the same leverage, and your margin warning could come around 58 cents. Now you can see how important leverage is. Lower leverage requires a bigger deposit but gives less room for your trade to move against you. Higher leverage requires a smaller deposit but gives more room for your trade to fluctuate before being closed. For example, if you have $10 with a leverage of 1 to 400, your trading power is $4,000. If you open a 0.01 position, your account may receive warnings around a $4 loss and could close early. But if another trader has the same $10 with a leverage of 1 to 1,000, they have $10,000 trading power. Opening the same 0.01 position, their margin warning may come around $9 loss, giving the trade more room to survive and possibly reverse into profit, while the first trader might have already been stopped out. As you can see, leverage is very important in CFD trading. It determines how much you can control in the market and how much room your trade has to move. That's why choosing the right broker is critical. Some of the brokers I use and recommend include IC markets with leverage up to 1 to 1,000, and FP markets with leverage up to 1 to 500. Now from this point, we are going to shift into the next section, where we connect all this knowledge to the actual trading software. This next part of the playlist will focus on CFD brokers and how to use their platforms. Stay tuned, and don't forget to like and subscribe.